Welcome to this CA Final Law Revision session on the Foreign Exchange Management Act, commonly known as FEMA. In this chapter, we will focus on import regulations, foreign exchange transactions, currency import rules, guarantees, and capital account transactions. FEMA is an important examination area because it combines legal provisions with practical business situations. Throughout this session, we will simplify complex provisions, understand the reasoning behind key regulations, and highlight important numerical limits frequently tested in examinations. Keep your revision notes ready, because many of the figures and timelines discussed here can directly help you score marks in the CA Final Law paper. Welcome to this CA Final Law Revision session on FEMA, focusing on imports, currency regulations, and capital account transactions. FEMA is a highly scoring area when concepts, timelines, and monetary limits are understood clearly. In this session, we will simplify the role of authorized dealers, obligations relating to foreign exchange, import payment rules, currency import limits, guarantees, and the distinction between capital and current account transactions. Rather than memorizing isolated provisions, we will understand the logic behind them so that examination questions become easier to tackle. Keep a close eye on the numerical limits because they are frequently tested in CA final examinations. Authorized dealers, commonly known as ADs, act as the primary regulatory interface between importers and the foreign exchange system. Whenever import payments are made, ADs must strictly comply with FEMA provisions and RBI regulations. In situations where specific regulations are not available, they must follow normal trade practices while ensuring compliance with RBI's Know Your Customer guidelines. Before permitting any remittance for import payments, the AD must verify all necessary information provided by the importer and ensure that the transaction is genuine, lawful, and represents a bona fide trade transaction. Only after satisfactory verification can the remittance be approved. Section 10(6) of FEMA imposes an important responsibility on every person acquiring foreign exchange. Foreign exchange must be utilized only for the purpose declared at the time of acquisition. If it is not used for that declared purpose, it may be used only for another purpose specifically permitted under FEMA, its rules, or regulations. This provision ensures that foreign exchange is not diverted for unauthorized activities. In simple terms, FEMA follows a principle of purpose-based utilization. Once foreign exchange is obtained, the user must remain accountable for how it is ultimately used and must be prepared to demonstrate compliance whenever required. When foreign exchange is used for importing goods, the importer must provide evidence proving that goods equivalent to the remittance value were actually imported. The authorized dealer has a responsibility to verify this evidence before closing the transaction. Acceptable evidence includes records available in the Import Data Processing and Monitoring System, commonly known as IDPMS, a postal appraisal form, or a customs assessment certificate. Additionally, ADs must ensure that outstanding import remittances are properly uploaded into the IDPMS system. The objective is to establish a clear link between the foreign exchange remitted and the goods received in India. As a general rule, import payments should be routed through normal banking channels. However, FEMA also recognizes modern payment mechanisms. A resident importer may pay for imported goods in foreign exchange using an international card held by them. Payments may also be made in Indian rupees through international credit or debit cards via the servicing bank against a signed charge slip. RBI may additionally prescribe other payment modes, provided they remain consistent with the foreign trade policy. Therefore, while banking channels remain the standard route, FEMA provides flexibility to accommodate evolving payment technologies and international trade practices. While import payments are generally made through banking channels, FEMA permits certain specific transactions in Indian rupees. First, a resident may pay for the boarding, lodging, travel, and other services of a person resident outside India who is visiting India. Second, payments for gold or silver imported in accordance with the Foreign Trade Act and other applicable laws may be made through a crossed check or demand draft. Third, an Indian company may pay sitting fees, commission, remuneration, and travel expenses in rupees to a non-whole-time director who is a non-resident visiting India for company-related work, subject to applicable corporate and legal requirements. One of the most important FEMA timelines for examinations is the 6-month settlement rule. For normal imports, remittances must be completed within 6 months from the date of shipment. The objective is to ensure timely closure of import transactions and prevent unnecessary foreign exchange exposure. However, FEMA recognizes that in certain situations, an importer may retain a portion of the payment as a performance guarantee. Such amounts are excluded from the normal 6-month requirement. Therefore, while 6 months is the standard rule, candidates should always remember the specific exception relating to performance guarantee amounts. Business disputes and financial difficulties sometimes make timely settlement impossible. FEMA therefore allows authorized dealers to permit delayed settlement of import payments in genuine cases. However, interest on delayed payments, usance bills, or overdue amounts is not unrestricted. Such interest can be paid only at the prescribed trade credit rate and only up to a maximum period of 3 years from the shipment date. The logic is simple. FEMA permits commercial flexibility, but discourages indefinite postponement of payment obligations. For examination purposes, remember the combination of 2 key points. Delayed settlement may be permitted, but interest is capped at 3 years from shipment. Deferred payment arrangements allow importers to postpone payment over a longer period. The permissible period depends upon the nature of goods imported. For capital goods, including arrangements such as supplier's credit or buyer's credit, deferred payment is permitted for up to 3 years. For non-capital goods, the permitted period is up to 1 year, or the operating cycle, whichever is shorter. FEMA treats these arrangements as trade credits, meaning they must comply with the RBI Master Direction governing external commercial borrowings, trade credits, and structured obligations. The key examination memory point is simple. Capital goods get 3 years, while non-capital goods get 1 year. Authorized dealers possess the power to grant extensions for settlement of import dues. Such extensions may be granted in blocks of 6 months at a time, subject to an overall ceiling of 3 years. Extensions are generally allowed where delays arise due to disputes regarding quality or quantity, non-fulfillment of contractual obligations, financial difficulties faced by the importer, or where legal proceedings have been initiated against the seller. This provision balances regulatory compliance with commercial realities. For examination purposes, remember the framework as 6-month extensions granted by ADs, but never beyond an aggregate period of 3 years. An authorized dealer cannot grant an extension automatically. Certain mandatory conditions must first be satisfied. Most importantly, the import transaction should not be under investigation by agencies such as the Directorate of Enforcement, the Central Bureau of Investigation, or any other statutory authority. Further, where the extension exceeds 1 year from the shipment date, an additional monetary test applies. The importer's total outstanding dues must not exceed the lower of $1 million or 10% of the average import remittances made during the preceding 2 financial years. Once approved, the extension must be properly reported in the IDPMS system under the Bill of Entry extension category. FEMA generally permits the import of foreign exchange into India, but certain declaration requirements must be followed. A person may bring unlimited foreign exchange into India upon arrival, provided the prescribed declaration is made through the Currency Declaration Form, commonly known as the CDF. However, a declaration is not required when the total value of foreign exchange, including currency notes, banknotes, and traveler's checks, does not exceed $10,000 and the cash portion in foreign currency notes alone does not exceed $5,000. These thresholds are frequently tested in examinations and should be remembered together as the FEMA CDF limits. FEMA also prescribes limits for bringing Indian currency into India after traveling abroad. A person resident in India returning from a temporary visit to any country other than Nepal or Bhutan may bring Indian currency notes up to a maximum value of 25,000 rupees. A special rule applies to Nepal and Bhutan. In such cases, Indian currency may be brought without any monetary limit, but only in denominations up to 100 rupees. Higher denomination notes are not permitted. The easiest way to remember this provision is that the rest of the world follows a 25,000 rupees cap, while Nepal and Bhutan follow a denomination restriction instead of a value restriction. To facilitate international trade, FEMA permits authorized dealers to issue various forms of guarantees relating to import transactions. ADs may guarantee debts or liabilities owed by an Indian importer to a person resident outside India in respect of deferred payment imports approved under RBI regulations. They may also issue guarantees, letters of undertaking, and letters of comfort in favor of overseas suppliers or banks for imports permitted under the foreign trade policy. In addition, Indian residents may issue corporate guarantees to overseas lessors for financing imports through operating lease arrangements, provided the transaction complies with FEMA provisions and the applicable trade policy framework. FEMA also permits authorized dealers to issue guarantees in favor of non-resident service providers on behalf of resident service importers. However, specific monetary limits apply. For non-government importers, the guarantee amount cannot exceed $500,000 or its equivalent. In the case of government entities and public sector undertakings, the limit is $100,000 or its equivalent. Any amount beyond this threshold requires prior approval from the Ministry of Finance. The logic behind these limits is to facilitate cross-border services while ensuring adequate regulatory oversight. For examination purposes, remember the pair together: $500,000 for private importers and $100,000 for government or PSU entities. We now move from import regulations to one of FEMA's most fundamental concepts: capital account transactions. Under FEMA, a capital account transaction is any transaction that changes the assets or liabilities, including contingent liabilities, across borders. In simple terms, if a person resident in India acquires or alters assets or liabilities outside India, or if a person resident outside India acquires or alters assets or liabilities within India, the transaction falls within the capital account category. The focus is therefore not on payment itself, but on whether the transaction changes the balance sheet position of a resident or non-resident. This concept forms the foundation of FEMA's regulatory framework. A simple way to distinguish between current and capital account transactions is through accounting concepts. Current account transactions are similar to profit and loss items because they relate to routine trade, services, and day-to-day payments. They generally do not create or alter long-term assets and liabilities across borders. Capital account transactions, on the other hand, resemble balance sheet items because they result in structural changes to assets, liabilities, or contingent liabilities between residents and non-residents. Therefore, whenever a transaction changes ownership, investment position, borrowing obligations, or other balance sheet elements across borders, it is generally classified as a capital account transaction under FEMA. Let us conclude with the most important examination takeaways from this chapter. Remember the 6-month rule for settlement of normal imports, the 3-year limit for deferred payments relating to capital goods, and the 1-year limit for non-capital goods. Memorize the CDF thresholds of $10,000 for aggregate foreign exchange and $5,000 for cash. Also remember the 25,000 rupees limit for importing Indian currency from most countries, along with the guarantee limits of $500,000 and $100,000. Finally, never confuse current account transactions with capital account transactions. If a transaction alters cross-border assets or liabilities, it belongs to the capital account category under FEMA. Congratulations on completing this FEMA revision chapter. Before moving to the next topic, take a few minutes to revise the key limits, timelines, and conditions discussed in this session. FEMA questions often test numerical thresholds and practical applications rather than lengthy theoretical provisions. Consistent revision and repeated recall of these figures can significantly improve examination performance. In upcoming sessions, we will continue simplifying important CA final law topics into easy-to-remember concepts and exam-oriented frameworks. If you found this revision useful, stay connected for more comprehensive law revision videos, practical illustrations, and last-minute examination boosters. Happy studying and all the best for your CA final preparation. Welcome to this comprehensive revision session on FEMA for CA Final Law. In this chapter, we will focus on capital account transactions, regulatory powers under Section 6, permissible and prohibited transactions, liberalized remittance scheme limits, and the external commercial borrowing framework. FEMA is heavily tested through conceptual understanding and numerical thresholds. Therefore, our objective is not merely to memorize provisions but to understand the logic behind them. By the end of this session, you will have a clear picture of how FEMA regulates cross-border assets, liabilities, investments, borrowings, and foreign exchange transactions, making revision faster and examination questions easier to tackle. To understand capital account transactions, begin with one important fact: the Indian rupee is not fully convertible. Therefore, capital account transactions are permitted only to the extent specifically allowed under FEMA. Capital and current account transactions are mutually exclusive. A capital account transaction is one that changes assets or liabilities across borders. For a person resident in India, it means altering assets or liabilities situated outside India, including contingent liabilities. For a person resident outside India, it means altering assets or liabilities located in India. Although FEMA permits foreign exchange transactions for capital account purposes, they remain subject to the regulatory powers of the RBI and the central government. A major change occurred in FEMA through the Finance Act 2015, which became effective from the 15th of October 2019. Prior to this change, the RBI regulated all capital account transactions. Today, regulatory powers are divided between the RBI and the central government. Debt instruments are regulated by the RBI in consultation with the central government, while non-debt instruments are regulated by the central government in consultation with the RBI. However, investments made by Indian residents outside India continue to be regulated by the RBI regardless of whether they involve debt or equity. This division of powers is one of the most important conceptual questions tested in examinations. Sections 6.4 and 6.5 allow both residents and non-residents to retain certain assets acquired before their residential status changed. A resident Indian may continue to hold foreign currency, foreign securities, or immovable property abroad if such assets were acquired when the person was a non-resident or inherited from one. Similarly, a non-resident may continue holding Indian currency, securities, or immovable property acquired while they were residents or inherited from residents. The RBI has further clarified that eligible foreign assets and income generated from them may be freely utilized for overseas payments or investments without requiring fresh RBI approval, provided FEMA provisions are followed. Although FEMA grants significant regulatory powers to the RBI and the central government, the law specifically protects two categories of transactions from restrictions. First, no restriction can be imposed on the drawal of foreign exchange for amortization of loans, which includes repayment of regular loan installments. Second, no restriction can be imposed for depreciation of direct investments arising in the ordinary course of business. The rationale is simple. Basic debt servicing and normal accounting adjustments should not face unnecessary regulatory obstacles. These two exceptions are small in wording, but highly important for examinations, because they represent statutory protections against regulatory interference. Schedule 1 of the FEMA Permissible Capital Account Transactions Regulations specifies the capital account transactions that a person resident in India may undertake. These include investment in foreign securities, raising foreign currency loans in India or abroad, transfer of immovable property outside India, and issuing guarantees in favor of non-residents. Residents may also undertake export, import, and holding of foreign currency, maintain foreign currency accounts, borrow from or lend to non-residents, purchase insurance policies from overseas companies, remit capital assets abroad, and enter into derivative contracts. Instead of memorizing each item separately, remember that Schedule 1 primarily deals with how Indian residents can legally interact with foreign assets, liabilities, A. Schedule 2 performs the opposite function by specifying capital account transactions that persons resident outside India may undertake in India. These include investing in Indian securities or contributing capital to firms, proprietorships, or associations of persons. Non-residents may acquire and transfer movable property in India, issue guarantees in favor of residents, import or export currency, maintain deposits with residents, operate foreign currency accounts in India, remit capital assets situated in India outside the country, and enter into derivative contracts. The easiest way to remember Schedule 2 is to view it from the perspective of a non-resident seeking to create, manage, or transfer financial interests within India. One of the most important FEMA limits for examinations is the liberalized remittance scheme limit. Under this framework, a resident individual may remit or draw foreign exchange up to $250,000 United States dollars per financial year for permissible capital account transactions covered under Schedule 1. This limit also includes certain current account transactions covered under Schedule 3, meaning those amounts are subsumed within the overall ceiling. If a specific FEMA regulation prescribes a different limit, that specific provision will prevail. An additional restriction applies to FATF-notified non-cooperative jurisdictions. No portion of the $250,000 United States dollars limit may be remitted directly or indirectly to such countries. Therefore, remember both the monetary limit and the FATF restriction together. While FEMA permits foreign investment in many sectors, certain activities remain completely prohibited for persons resident outside India. These include investment in niddy companies, agricultural or plantation activities, real estate business, construction of farmhouses, trading in transferable development rights, and chit funds. However, important exceptions exist. Real estate business does not include development of townships, residential or commercial premises, roads, bridges, or investments through SEBI-registered REITs. Similarly, NRIs may participate in chit funds, if approved by the Registrar of Chits, conducted through banking channels, on a non-repatriation basis, and subject to RBI conditions. Examiners frequently test these exceptions, rather than the basic prohibitions. FEMA contains a specific country-based restriction relating to the Democratic People's Republic of Korea, commonly known as North Korea. A person resident in India cannot undertake any capital account transaction with a citizen, resident, or entity of North Korea unless specific approval is obtained from the central government. This restriction extends even to existing investments and assets already held in that country. Where a transaction is not permissible, it must be closed, liquidated, disposed of, or settled within 180 days from the notification date, unless special approval is granted for continuation. The objective is to align India's foreign exchange regulations with international obligations and national policy considerations. External commercial borrowings, commonly known as ECBs, are commercial loans raised by eligible resident entities from recognized non-resident lenders. Governed under FEMA, ECBs are subject to a comprehensive regulatory framework. A crucial principle is the rule of totality, meaning compliance is required with all prescribed conditions, such as minimum maturity, permitted end uses, and all-in cost ceilings. Compliance with one condition alone is not sufficient. ECBs may be raised through two routes. Under the automatic route, proposals are examined and approved by authorized dealer Category 1 banks. Under the approval route, borrowers must submit applications through their AD banks for examination and approval by the RBI. The all-in cost ceiling determines the maximum cost that a borrower can incur while raising ECBs. It includes interest, fees, expenses, charges, and guarantee fees, whether payable in foreign currency or Indian rupees. However, commitment fees, prepayment charges, and withholding tax payable in rupees are excluded from this calculation. For foreign currency ECBs, the ceiling is the benchmark rate plus 500 basis points, while for rupee-denominated ECBs, it is the benchmark rate plus 450 basis points. Additionally, issue expenses for FCCBs are capped at 4% for public issues and 2% for private placements. Penal interest for defaults may be charged up to 2% above the contracted rate. FEMA permits ECBs in two broad forms: foreign currency ECBs and Indian rupee ECBs. FCY ECBs may take the form of bank loans, notes, bonds, debentures, trade credits exceeding 3 years, FCCBs, FCEBs, and financial leases. INR ECBs include bank loans, notes, bonds, debentures, preference shares, trade credits beyond 3 years, financial leases, and plain vanilla rupee-denominated bonds issued overseas. A critical restriction applies to both categories. Fully convertible and compulsorily convertible instruments are not permitted under the ECB framework. Therefore, while the borrowing currency may differ, the objective remains the same: facilitating long-term foreign borrowing within a regulated structure. Not every borrower and lender can participate in the ECB framework. Eligible borrowers for FCY ECB include entities eligible for FDI, port trusts, SEZ units, SIDBI, and EXIM Bank. INR ECB eligibility extends further to include registered microfinance entities such as NGOs, trusts, societies, and cooperatives. On the lending side, recognized lenders must generally belong to FATF or IOSCO-compliant jurisdictions. Certain exceptions are also permitted, including multilateral financial institutions, where India is a member, eligible foreign equity holders, and specific bond subscribers. Foreign branches or subsidiaries of Indian banks may participate in FCY ECB transactions, but are subject to various restrictions under FEMA regulations. The minimum average maturity period, or MAMP, is one of the most important ECB concepts for examinations. The general rule prescribes a minimum maturity period of 3 years, and call or put options cannot be exercised before its completion. However, several exceptions exist. Manufacturing companies borrowing up to $50 million per financial year enjoy a 1-year maturity requirement. ECBs from foreign equity holders for working capital, general corporate purposes, or rupee loan repayment require a 5-year maturity. Certain borrowings for capital expenditure require 7 years, while others require 10 years. These exceptions are frequently tested, making MAMP one of the most important FEMA numerical areas. While ECBs provide access to foreign funding, FEMA imposes strict restrictions on how those funds can be utilized. ECB proceeds cannot be used for real estate activities, investment in capital markets, or equity investments. They also cannot generally be used for working capital requirements, general corporate purposes, or repayment of Rupee loans, unless specifically permitted under certain MAMP-based exceptions. Further, on-lending of ECB funds for such prohibited activities is also restricted, except in limited cases involving eligible NBFCs. The purpose of this negative list is to ensure that foreign borrowings are used for productive economic activities rather than speculative or high-risk transactions that may affect financial stability. FEMA permits certain changes in the currency of ECB borrowings. A borrower may convert one freely convertible foreign currency into another freely convertible foreign currency, or convert foreign currency borrowings into Indian rupees. However, conversion from Indian rupees into a freely convertible foreign currency is strictly prohibited. FEMA also imposes hedging requirements to manage exchange risk. Infrastructure sector entities with ECB maturity below 5 years must hedge at least 70% of their exposure, covering both principal and coupon payments. The hedging arrangement must have a minimum tenor of 1 year and should ensure that the exposure never remains unhedged during the borrowing period. The ECB framework contains important monetary and leverage limits. Eligible borrowers may raise ECBs up to $750 million or its equivalent per financial year under the automatic route. Where the ECB is obtained from a direct foreign equity holder, the liability-equity ratio generally cannot exceed 7:1. However, this ratio does not apply where the total outstanding ECB exposure is up to $5 million. FEMA also imposes strict restrictions on guarantees. Indian banks, all India financial institutions, and NBFCs are prohibited from issuing guarantees relating to ECBs. Additionally, financial intermediaries are not permitted to invest in FCCBs or FCEBs in any manner whatsoever. Let us quickly revise the most important FEMA provisions covered in this chapter. Debt instruments are regulated by the RBI, whereas non-debt instruments are regulated by the central government. Resident individuals may remit up to $250,000 annually under the liberalized remittance scheme. Non-permissible transactions involving North Korea must generally be liquidated within 180 days. Under the ECB framework, the automatic route permits borrowings up to $750 million per financial year. The all-in cost ceiling is benchmark plus 500 basis points for FCY ECBs and benchmark plus 450 basis points for INR ECBs. Finally, remember the 7:1 liability-equity ratio applicable in specified cases. As we conclude this FEMA revision chapter, focus your final revision on exceptions, numerical thresholds, and conceptual distinctions. Examiners frequently test exceptions to general rules, such as permitted investments in chit funds, exemptions from real estate restrictions, and special ECB maturity categories. Pay particular attention to the MAMP ladder of 1, 3, 5, 7, and 10 years, along with key limits such as $250,000 under LRS and $750 million under ECB regulations. Always distinguish clearly between transactions involving residents and non-residents, because many FEMA questions revolve around residency status. Consistent revision of these figures and exceptions will significantly improve your accuracy and confidence in the examination hall.